Charles Schwab. Chief investment strategist Ann Sonders joins us now. Ann, how does the path for Fed policy this year influence what you're telling your clients to do in the market?
Well, they're in data-dependent mode, which means everybody, Fed watchers and the market itself, is at the mercy of the incoming data. And I think that's where short-term volatility could persist, because the Fed isn't on a predetermined course and they're just waiting to, drip the information out to us slowly, market watchers. So that's why I think, Pardon me?
Oh, no, you're good. Keep going. We're listening.
Oh, sorry. I had somebody in my ear. Sorry. I thought Carl was jumping in. So I think that will continue to be a mover, which also suggests that relative to the dual mandate of the Fed, you might not necessarily need to see a big outsized surprise, whether it's CPI or PPI or jobs data, just marginally, and that could change the perspective on what the Fed has to do. Even before the most recent FOMC meeting, we felt that a start of rate cuts in March was premature, and it just was not supported by the backdrop of the combination of labor market data and inflation data. And I do think, and Powell did emphasize this, I think the labor market data comes into sharper focus for the Fed, and he specifically said that in the press conference. Not that they've now taken their eye off inflation, which was the key driver on the upside in terms of rates, but that's a bigger part of the mix, and the decision-making process will be associated with the labor market data. So I think that we're all at the mercy of every week and what data it brings.
But, so far, the bullish narrative, what's driven stocks to record highs here, Ann, has been, besides AI, better economic data, continued mild inflation, and the next move, whether it's in the middle of the year or the first half of the year, second, it's going to be a cut. Does that continue to be the predominant theme in the markets? And
well,
do you expect continued strength?
That's a predominant theme, but mostly to the support of larger cap names. If you look at the indexes, yes, the S&P and the NASDAQ not all far from all-time highs, but you look under the surface, there's been this distribution, this corrective process going on under the surface, which, by the way, is not necessarily an unhealthy thing. You just don't get a full picture of what the market is doing by just looking at the indexes. In fact, just year to date, the average member maximum drawdown within the NASDAQ is 19%. That's almost bear market territory. 15% for the Russell 2000. Not yet, less than 10% for the S&P 500. But that just shows you that even though it's not just the Mag 7 anymore, that there's dispersion there, you are still seeing that cap bias flatter the cap-weighted indexes. But the real story has been happening under the surface.
Ann, I wonder if you had some thoughts about household balance sheets, because we were just talking about credit card spend. On Friday, Morgan Stanley issued this from their econ desk, this cautionary note about buy now, pay later, saying it bears watching, that because of lending standards getting tighter and delinquencies creeping up, that maybe households start to take on more than they can handle. How much of that is on your radar?
So it is definitely on the radar, but I think when looking at households, when looking at the consumer, you can't use a monolithic lens. That might have been the case when excess savings story was all the rage and you had a massive amount of excess savings, but that's now been largely drained down the income and wage spectrum. And that's why you're seeing that increased use of buy now, pay later. We're starting to see a pretty significant increase in delinquencies, but it's more concentrated down the income spectrum in the subprime categories, whether it's for auto or credit card loans. So I think there's now this segment of the consumer that is weakening. But even more broadly, you might not pick it up in a lagged metric like overall GDP, but you look at hours worked, which even in the face of very strong jobs numbers, particularly the most recent one, you still have that decline in hours worked. You already mentioned the NABE survey suggesting that there is some weakening demand. I just don't think you can sort of paint the consumer with a very broad brush. I think the weakness is starting to be felt, again, down the income spectrum in those subprime categories, but it bears watching in terms of that sort of spread up the spectrum a bit.